Episode 3. Why companies go for public offerings. Raising capital. Going public allows companies to raise capital by selling shares of the company to investors. This can provide a large amount of funds that can be used for growth, expansion, research and development, or paying off debt. Enhancing brand and reputation. Going public can enhance a company's brand and reputation. By being listed on a stock exchange, a company can gain more visibility and credibility, which can help attract customers, partners, and employees. Providing liquidity. Going public can provide liquidity for existing shareholders, allowing them to sell their shares on the stock market. This can provide an exit opportunity for early investors and employees, and can also help attract and retain talent by providing a way to realize the value of their equity. Increasing shareholder base. Going public can help a company attract a larger shareholder base, which can provide more diverse sources of capital and potentially reduce the risk of dependence on a few large investors. Improving valuation. Going public can improve a company's valuation by increasing its visibility, credibility, and access to capital. This can help the company attract more investors and potentially increase its stock price. Primary and secondary markets. The primary market refers to the market where securities, such as stocks and bonds, are created and sold for the first time. This is also known as the new issue market. Companies, governments, or other entities can issue securities to raise capital for their operations, and these securities are typically sold to institutional investors, high net worth individuals, or the public. The secondary market is where previously issued securities are bought and sold by investors. The stock exchanges, such as the National Stock Exchange (NSE) and Bombay Stock Exchange (BSE), facilitate the trading of these securities between buyers and sellers. The secondary market allows investors to trade securities among themselves, without any involvement from the issuer of the securities. The initial public offering (IPO) refers to the process by which a privately held company goes public by offering its shares to the public for the first time. An IPO is typically undertaken by a company that wants to raise capital to fund its growth or to allow its founders and early investors to exit the company and realize their investment. The IPO process involves several steps, including selecting investment banks to manage the offering, preparing a prospectus that details the company's business and financials, and pricing the shares to be sold. Once the shares are priced, the company makes an offering to the public, and investors can place orders for the shares through their brokers. Investing in an IPO can be an attractive opportunity for investors looking to participate in the growth of a promising company from its early stages. However, investing in IPOs also comes with risks, as the company may not perform as well as expected, and the share price may fall. The IPO market is closely watched by investors and analysts as it is often seen as a barometer of market sentiment and the overall health of the economy. The number of IPOs and the amount of capital raised through IPOs can be an indicator of the level of investor confidence and optimism in the market. A follow-on public offering (FPO) is a type of securities offering in which a publicly traded company issues new shares of its stock to the public. Unlike an IPO, in which a private company goes public for the first time, an FPO allows an already public company to raise additional capital by issuing more shares. FPOs are often used by companies to finance growth opportunities, pay down debt, or make strategic acquisitions. The FPO process is similar to that of an IPO, with the company selecting investment banks to manage the offering, preparing a prospectus, and pricing the shares to be sold. Existing shareholders of the company may also participate in the FPO, either by selling their own shares in the offering or by buying additional shares to maintain their ownership percentage in the company. Like with IPOs, investing in FPOs comes with risks, and the share price of the company may decline if the market does not respond favorably to the offering. It's important for investors to conduct research and understand the risks involved before investing in an FPO. Overall, FPOs are an important way for publicly traded companies to raise capital and fund their growth strategies, while providing investors with an opportunity to participate in the company's success. OFS stands for Offer for Sale. It is a type of auction-based mechanism used in the Indian stock market that allows promoters of a publicly traded company to sell their shares to the public. In an OFS, the company's promoters, who hold a significant amount of the company's shares, sell a portion of their holdings to the public through a stock exchange. The OFS mechanism is primarily used to comply with the minimum public shareholding norms mandated by SEBI, Securities and Exchange Board of India. SEBI requires that publicly traded companies must maintain a minimum public shareholding of 25%, and an OFS is one way for promoters to reduce their stake in the company and meet this requirement. The OFS process is similar to a regular share sale, with the difference being that the shares are offered for sale to the public through an auction process on the stock exchange. The auction process involves setting a floor price for the shares and allowing investors to bid for the shares that are above this price. The shares are then allocated to the highest bidders. OFS offers several benefits to both promoters and investors. For promoters, an OFS allows them to comply with regulatory requirements and monetize their holdings. For investors, an OFS offers an opportunity to acquire shares of a publicly traded company at a fair price. It's important for investors to conduct research and understand the risks involved before participating in an OFS. Like any investment, an OFS comes with risks, and the share price of the company may decline if the market does not respond favorably to the offering. A rights issue is a way for a publicly traded company to raise capital by offering its existing shareholders the right to buy additional shares of the company's stock at a discounted price. In a rights issue, a company issues new shares to its existing shareholders in proportion to their existing holdings. For example, if a company announces a rights issue in the ratio of 1:4, it means that for every 4 shares that a shareholder owns, they will have the right to buy 1 additional share at a discounted price. The discounted price is usually lower than the current market price of the stock and is set by the company. The purpose of a rights issue is to raise capital quickly and easily from existing shareholders. By offering shares at a discounted price, the company incentivizes its existing shareholders to invest more money in the company, which can help fund the company's growth plans, pay down debt, or fund other strategic initiatives. Rights issues are typically offered for a limited time, and shareholders must decide whether to exercise their rights by buying additional shares or not. If a shareholder decides not to exercise their right, they can sell their rights on the stock exchange to other investors who may want to buy the discounted shares. In summary, a rights issue is a way for a company to raise capital by offering existing shareholders the right to buy additional shares at a discounted price, which can help fund the company's growth plans and other strategic initiatives. Next episode. Why do stock price fluctuates?